Federal Reserve has begun its two-day policy meeting and is all but certain to continue winding down its economic stimulus, part of its great monetary policy experiment following the financial crisis. And for the past 5 years, the Fed has pegged interest rates at zero and put about $4 trillion worth of extra cash into the banking system and on its balance sheet. So what happens when the central bank tries to bring rates and its balance sheet back to normal? Will it end badly or well? Steve Liesman reports.
The market expects the Federal Reserve to stop buying assets this year and around this time next summer to raise interest rates for the first time since 2009. So what happens then? Can the Fed exit its extremely easy monetary policy smoothly, or will it all end badly? The July CNBC Fed survey finds the market evenly divided between doomsayers and soothsayers. 34% say it will end badly in a recession or a market sell-off or higher inflation. 34% say it could end well, and about a quarter say it could go either way.
Well, I think we've had periods in the past with very low interest rates, very easy monetary policy, and in the past they've ended badly. I think in this particular period, there are even more risks and challenges to what monetary policy has done. And I think the Fed, to pull this off, has got to get too many things just right. I don't think it will get that many things just right.
Brusca thinks inflation will rise, forcing the Fed to raise interest rates to cool down the economy, causing a spike in interest rates, and that could cause stocks to sell off and ultimately result in a recession. But John Lonsky of Moody's Capital Markets disagrees. He's not worried about inflation, at least not until he starts seeing the money the Fed has pumped into the system, called excess reserves, being turned into loans.
Till I begin to see this increase in reserves, this huge balance sheet, produce more in terms of loan growth, chances are it is not going to go ahead and trigger a lasting upturn by inflation.
Both economists agree the Fed will need to tread carefully. Lonsky thinks the Fed can do it, but Brusca says it has to move interest rates from zero all the way to 4%.
It's like asking me, how can you drop an egg from a 10-story building and have it not break? I don't know. How can you?
The Fed will try and not break any eggs at its meeting tomorrow. It's expected to reduce its bond purchases by $10 billion, bringing them down to $25 billion a month, and could signal those purchases will end in October. Part of the Fed's effort at a smooth exit and to prove wrong those who think it can't end well. For Nightly Business Report, I'm Steve Liesman.